Hello everyone. Now in the booster series of lectures, let us start with the next chapter, capital gains. There are many amendments that came in Finance Act number 2 of 2024 with regard to capital gains chapter. All the amendments are very clearly covered in this booster series lecture. So when you listen this lecture, it will be like revision of capital gains chapter. Along with that, new amendments are also covered very elaborately along with problem. Okay. So shall we start? Yes. What are the sections that are covered under the head capital gains? Section 45 to 54. These are the sections that are covered under the head capital gains. Charging section is section 45. Generally, when capital gains head gets attracted, whenever you sell any asset, then capital gains head gets attracted. So what is the method of accounting that is followed? Method of accounting followed is accrual basis. What do you mean by accrual basis? The year in which capital asset was actually transferred. In the year of transfer only, capital gains will get attracted. For example, in 24-25, I sold one building for 1 crore rupees. But buyer promised me that he will pay consideration of 1 crore rupees in next previous year 25-26. I transferred in current previous year, but I am receiving consideration in next previous year. In which year capital gains are taxable? Capital gains are taxable in current previous year 24-25 because building got transferred in current previous year. That means what? Irrespective of receipt of consideration, capital gains are always taxable in the year in which capital asset was actually transferred. Capital gains are taxable on accrual basis. Even though consideration is received in next year, they are taxable in current previous year in the year in which they are actually transferred. Except section 45(1)(a), 45(2), 45(5). In these three cases, capital gains are not taxable in the year of transfer. That we are going to discuss further. But basically, method of accounting followed under the head capital gains is accrual basis. Next, under the head capital gains, normal tax rates are applicable, special tax rates are also applicable. Section 112, 112A, section 111A, for these three sections, special tax rates are there. Along with that, normal tax rates are also applicable for capital gains chapter. First, see, the charging section is section 45. Section 45 clearly says that two conditions are there. If these two conditions are satisfied, then 45 gets attracted. First condition is asset transferred should be a capital asset. That means only if you transfer capital asset, then only capital gains gets attracted. You transferred one asset, but that asset is not a capital asset, then capital gains will not get attracted. Capital gains will arise only if the transferred asset is capital asset. So condition 1 is asset transferred should be a capital asset. Condition 2 is it should fall under the definition of transfer. Whatever the transfer, mode of transfer is there, that should fall under the definition of transfer. Then only capital gains gets attracted. Okay. So condition 1, asset should be capital asset. Condition 2, mode should fall under the definition of transfer. Mode of transfer should fall under the definition of transfer. That is condition 2. If both these conditions are satisfied, condition 1 and condition 2, then only capital gains gets attracted. Asset should be a capital asset, transaction should fall under the definition of transfer. First, let us see definition of capital asset. If asset is capital asset, capital gains gets attracted. Asset is not a capital asset, capital gains will not get attracted. So whenever asset transferred is there, you have to check asset transferred. If it is capital asset, then capital gains will get attracted. If asset transferred is not a capital asset, then capital gains will not get attracted. Are you able to understand? Now let us see the definition of capital asset. Capital asset definition has inclusions as well as exclusions. That means capital asset includes. If asset falls under capital asset includes, then capital gains gets attracted. If asset is excluded from definition of capital asset, then no capital gains will arise. So first let us see what are all included in definition of capital asset. Property of any kind held by an assessee, whether or not connected with his business or profession. In simple, all assets are capital assets. Whether it is movable asset or immovable asset, whether it is tangible asset or intangible asset, whether it is used in the business or not, every asset is a capital asset. What is important is exclusions. Whatever the assets excluded from definition of capital asset are there, those are not capital assets. If they are not capital assets, on transfer of them, capital gains will not arise. So capital gains will not arise if asset is excluded from definition of capital asset. Are you able to understand? So basically every asset is included, whether it is movable asset or immovable asset, tangible asset or intangible asset, or whether it is used in the business or not. Every asset is simply covered under the definition of capital asset. What is important is exclusions. So now let us see what are the assets that are excluded from definition of capital asset. First, stock in trade is excluded from definition of capital asset. Sir? Why stock in trade is excluded? When you sell stock in trade, PGBP head gets attracted. So on sale of stock in trade, already PGBP head is getting attracted. If stock in trade is not excluded, means capital gains head also gets attracted. That means what? On sale of stock in trade, PGBP will levy tax, capital gains will also levy tax. It amounts to double taxation. So to prevent double taxation, stock in trade is excluded from definition of capital asset. So stock in trade is not a capital asset. On sale of stock in trade, PGBP head gets attracted, capital gains will not get attracted because stock in trade is not a capital asset. It is excluded from definition of capital asset. Is it clear? Next. Personal effects. Sir, what do you mean by personal effects? To call an asset as personal effect, 3 conditions are required to be satisfied. How many conditions? 3 conditions. Condition 1, it must be a movable asset except security. That means what? Before I tell you these conditions, I will tell another point. See, if asset is a personal effect, if asset is a personal effect, then it is not a capital asset, right? If it is not a capital asset, capital gains will not arise because personal effect is excluded from definition of capital asset. Personal effect is not a capital asset. If personal effect is not a capital asset, then capital gains will not arise. Asset is not a personal effect. If asset is not a personal effect means what? Then it is a capital asset. Exclusion to exclusion, minus into minus plus. Personal effect is excluded. Asset is not a personal effect. So personal effect is excluded, not a personal effect, minus into minus. So if it is not a personal effect means it is a capital asset and capital gains will arise. Are you able to understand? For example, condition 1. What is condition 1? Only if asset is a movable asset, then only we call it as personal effect. For example, land is there. I own one land. That land is not a movable asset. Land is a immovable asset. Even though I purchased land for my personal purposes, still it is not a personal effect. Why it is not a personal effect? Because condition 1 clearly says only movable asset can be a personal effect. So land is not a personal effect because land is a immovable asset. Now land, is it a personal effect? Land is not a personal effect. If land is not a personal effect, it is a capital asset. So even though I purchased land for my personal purposes, it is not a personal effect, it is considered as capital asset, and on transfer of land, capital gains will arise. Are you able to understand? Good. So asset must be a movable asset except security. That means shares, securities, all these are also not considered as personal effects. Even though you purchased shares for personal purpose, they are not considered as personal effects because condition 1 clearly says that except security, movable asset except security. Share, securities, these are movable assets, but they are excluded, they are not personal effects. That means what? Shares and securities, they are not personal effects. If they are not personal effects, they are considered as capital assets and capital gains are required to be calculated. Next. So to call an asset as personal effect, it should be a movable asset except security and should be used for personal purpose of SSC. Personal purpose by SSC or his family members. For example, iPad is there. I purchased it for my professional purpose. iPad is a mobile asset, but this iPad I cannot call as personal asset because why? I am using this iPad not for personal purpose. I am using this iPad for official purposes, business purposes. So even though asset is mobile asset, if it is used for business purpose, it is not a personal asset. Only if it is used for personal purpose, then only it will be considered as personal effect. Are you able to understand? Next, condition 3, exclusions. Certain things are excluded from definition of personal effect. Those are not considered as personal effect. What are they? What are excluded from definition of personal effect? Jewelry, drawings, paintings, archaeological collections, sculptures, work of art. These are excluded from definition of personal effect. That means jewelry is there, even though it is movable asset, even though it is used for personal purpose, still it is not considered as personal effect because that is excluded from definition of personal effect. Is it clear? Are you able to understand? So that's what the conjunction is, and all the three conditions are to be satisfied. So asset should be a movable asset and it should not be a security, and asset should be used for personal purpose of the SSC, and if asset is excluded, then it is not a personal effect. Asset should not fall under exclusions, then only it is considered as personal effect. So three conditions: should not fall under exclusions. Only if these three conditions are satisfied, then only we call that asset as personal effect. I will tell one example. Let's say I am using one mobile. I am carrying two mobiles. One mobile I am using for my official purposes, business purpose. One mobile I am using for my personal purpose. So whatever the mobile that I am using for my personal purpose is there. Mobile is a movable asset. I am using that mobile for my personal purpose. Mobile is not a jewelry. Mobile is not excluded from personal effect. Why? Because mobile is not a jewelry. Mobile is not a drawing. It is not a painting. It is not a work of art. So as all the three conditions are satisfied, my mobile is a personal effect. It is not a capital asset. Are you able to understand? So to call an asset as personal effect, it should be a movable asset and it should not be a security, and it should be used for personal purpose either by SSC or his family members, and whatever the movable asset is there, it should not fall under exclusions. If it falls under exclusions, then it is not a personal effect. Are you able to understand? If it does not fall under exclusions, then it is a personal effect. What are exclusions? Jewelry. Jewelry means what? Any item which is made of gold or silver or platinum, or which is made of precious stones, that item we call as jewelry. Jewelry, even though it is movable asset, even though it is used for personal purpose, it is not a personal effect. Why? Because jewelry is excluded from definition of personal effect. So if jewelry is not a personal effect, then it is a capital asset. On transfer of jewelry, capital gains are required to be calculated. That's why whenever we sell gold, we will calculate capital gains on sale of gold. Are you able to understand? Good. Next, archaeological collections, drawings, paintings, sculptures, work of art, like all these things, even though they are movable assets, they are not considered as personal effects because they are excluded from definition of personal effect. They are not personal effects. If they are not personal effects, they are considered as capital assets, and capital gains are required to be calculated. So stock in trade is excluded from definition of personal effect. Stock in trade is not a capital asset. Personal effect, any asset which satisfies three conditions, that asset is a personal effect. So any asset which is a personal effect, it is excluded from capital asset definition, and no capital gains are required to be calculated. If asset is not a personal effect, then again it will fall under the definition of capital asset, and capital gains are required to be calculated. Next, rural agricultural land. Agricultural land is classified into two types. Agricultural land, if it is located in specified area, then we call that agricultural land as urban agricultural land. If agricultural land is located in non-specified area, then we call that agricultural land as rural agricultural land. So what is excluded from definition of capital asset? Rural agricultural land is excluded from definition of capital asset. That means what? Urban agricultural land is a capital asset. On transfer of urban agricultural land, capital gains will arise. See, rural agricultural land in India, that means what? Only if agricultural land is rural agricultural land and that agricultural land is situated in India, then only it is excluded from definition of capital asset. For example, let's say I have agricultural land in USA. It is rural agricultural land. Still it is considered as capital asset only if agricultural land is rural agricultural land and it is situated in India, then only it is excluded from definition of capital asset, and on sale of such rural agricultural land, capital gains are not required to be calculated. Sir, how do we know whether agricultural land is rural or urban? We have to go through the definition of specified area. If agricultural land falls within the specified area, then that agricultural land we call as urban agricultural land. If agricultural land is outside the specified area, then that agricultural land we call as rural agricultural land. Is it clear? Let's say this is specified area. Within this specified area, there is agricultural land. This agricultural land we call as urban agricultural land. Outside specified area, there is agricultural land. This agricultural land we call as rural agricultural land. And this rural agricultural land is not a capital asset. Is it clear? So what we need to know now is specified area. So let us go through the definition of specified area. Asset is a like agricultural land is within the specified area. So it is urban agricultural land. Agricultural land is outside specified area. It is rural agricultural land. Now, population. So wherever the agricultural land is there, in that municipality, if population is less than or equal to 10,000, then that municipality, that agricultural land, we can say it is not a specified area. That agricultural land is located in non-specified area. If agricultural land is located in non-specified area, then obviously it is a rural agricultural land. Next, if agricultural land is located in a municipality and in that municipality if population is greater than 10,000 and up to 1 lakh, let's say there is a municipality. In this municipality, population is greater than 10,000 but less than, greater than 10,000 but less than or equal to 1 lakh. Now, this municipality is specified area. Not only municipality, from end of the limits, see from end of the city limits, whatever the 2 kilometers area is there, even this area is also considered as specified area. So, if agricultural land is located within this specified area, that agricultural land we call as urban agricultural land. If agricultural land is located outside specified area, we call it as rural agricultural land. Is it clear? So, population in a city, if it is less than or equal to 10,000, then that area, that the agricultural land located in such area, that agricultural land we call as rural agricultural land, because agricultural land is located in non-specified area. If population in that municipality is greater than 10,000 and up to 1 lakh, then that area we call as specified area. Not only that municipality area, 2 kilometers from the end of the municipality is also considered as specified area. If agricultural land is located in specified area, then that agricultural land, urban agricultural land. Outside specified area, rural agricultural land. If population in a place is greater than 1 lakh and up to 10 lakh, that means what? In a city, population is greater than 1 lakh and up to 10 lakh. Best example, Vijayawada. Now, this city is a specified area. Whatever the city limits are there, they are specified area. Not only city limits, from end of the city limits, whatever the 6 kilometers area is there, this is also called as specified area. Within that specified area, if there is agricultural land, that agricultural land we call as urban agricultural land. Outside specified area, if there is agricultural land, that agricultural land we call as rural agricultural land. So very simple. Population in a place, if it is less than or equal to 10,000, non-specified area. Population in city greater than 10,000 and up to 1 lakh, that municipality is a specified area. Along with municipality, 2 kilometers from local limits of municipality is also considered as specified area. Population greater than 1 lakh and up to 10 lakh, municipality area plus 6 kilometers from local limits of municipality. Hyderabad is there. In Hyderabad, population is greater than 10 lakhs. So Hyderabad is completely a specified area. Not only Hyderabad, from municipal limits of Hyderabad, whatever the next 8 kilometers are there, even that 8 kilometers are also considered as specified area. Okay, so within that specified area, if agricultural land is there, that agricultural land we call as urban agricultural land. Outside specified area, if there is agricultural land, that agricultural land we call as rural agricultural land. Rural agricultural land is excluded from definition of capital asset, and capital gains are not required to be calculated. Next, gold bonds. See, gold bonds issued in 1977, 1980, 1980, 1991. See, these are not alive right now. They are all expired. So what are alive are deposit certificates issued under Gold Monetization Scheme 2015-2018. So if any deposit certificates are issued under Gold Monetization Scheme, those deposit certificates are excluded from definition of capital asset. If you sell those deposit certificates, capital gains will not arise. So every asset is a capital asset except stock in trade, personal effects, rural agricultural land in India, deposit certificates issued under Gold Monetization Scheme. So for these 4 capital assets, even though they are sold, capital gains will not arise. Now let us discuss the definition of transfer. Only if transaction is included in definition of transfer, then only capital gains gets attracted. If transaction is excluded from definition of transfer, then by way of the transaction, if any asset is transferred, capital gains will not get attracted. For example, gift is excluded from definition of transfer. So as an individual, I gave gift. That means through gift, I am transferring my asset to another person. On this transaction, capital gains will not arise because gift transaction by an individual is excluded from definition of transfer. Is it clear? So let us see. Transfer includes sale. That means if any capital asset is sold, obviously capital gains gets attracted. Exchange of capital asset. That means what? If you exchange your capital asset with another asset, obviously not only in case of sale, even if there is exchange of capital asset, capital gains are required to be calculated. Are you able to understand? For example, I gave a gold ring. In return, I purchased this mic. Okay, this mic is worth 35,000, right? So I am giving gold ring and I am taking mic. So there is exchange of capital asset with another asset. Now even for this exchange also, capital gains are required to be calculated. Next, relinquishment of rights in a capital asset. What do you mean by relinquishment? There is one building. This building is taken on lease by me. Taken on lease by me for 5 years. Rent is 50,000 per month. Tomorrow, my friend came to me and told, this building I want for the next 5 years. As you are the lessee, you took this building on lease for 5 years for 50,000 per month. Now I will give you 3 lakh rupees. That means what? My friend is giving 3 lakh rupees to me. He is giving 3 lakh rupees to me. Why he is giving 3 lakh rupees to me? I will vacate the house property now and he will start occupying the house property after taking the permission of the owner. That means whenever I took house on lease for 5 years, I am holding lease rights for 5 years. These lease right of 5 years, I am transferring to another person for 3 lakh rupees. That means what? Whatever the lease right that I am having on this house, I am losing the lease right. I am transferring the lease right to my friend. So for losing the lease right, for giving up the lease right, for relinquishing the lease right, if I receive any consideration, capital gains are required to be calculated. So relinquishment means what? Giving up the rights of the asset. So if any SSC by way of giving up right on the asset. If he receives any consideration, then also capital gains are required to be calculated. Is it clear? Next. Extinguishment of capital asset. What do you mean by extinguishment? Extinguishment means cancellation of capital asset. For example, my building got destroyed. Insurance company paid compensation. So destruction of capital asset we call as extinguishment of capital asset. Another example, I have equity shares with me. Company bought back equity shares and return of the equity shares. So whenever company buys back the equity shares and return rights of the equity shares, there are no more equity shares. So buyback is we can call as extinguishment of capital asset. So whenever company buys back and writes off, then capital asset will not exist. So even in case of buyback also, capital gains are required to be calculated. Many students ask me, sir, what is the difference between relinquishment and extinguishment? In case of relinquishment, asset will continue to exist, but in case of extinguishment, asset will not exist. In relinquishment example, I transferred the lease right to my friend. My friend occupied the building. See, asset is in existence, but it is occupied by another person. But in case of extinguishment, asset will not exist. Destruction of building, okay, bought back of shares, redemption of debentures, asset will not exist, okay. So that is the main difference between relinquishment and extinguishment. Compulsory acquisition of capital asset. Whenever government do compulsory acquisition, government will pay compensation, right? In that case also capital gains are required to be calculated. Next, conversion of capital asset into stock in trade. So whenever capital asset is converted into stock in trade, then also capital gains are required to be calculated. Maturity or redemption of zero coupon bonds. You know zero coupon bonds, right? They are always issued at a discount and are redeemed at par, redeemed at face value. So at the time of redemption of zero coupon bonds, whatever the amount that is received, on such amount capital gains are required to be calculated, because redemption is included in definition of transfer. Next, transfer by way of part performance of a contract. You know, right, section 53 of Transfer of Property Act. If you remember deemed ownership concept, we have discussed the transfer of section 53 of Transfer of Property Act. Three conditions are there. There should be agreement in writing in between seller and buyer. Buyer has paid the consideration, or buyer is ready to pay the consideration. Buyer has taken the possession of the property. If all these three conditions are satisfied, means even though property is not legally registered in registered office, still buyer will be considered as deemed owner of the house property. Do you remember? So same case, in buyer case we have discussed deemed ownership concept. In seller case it is considered as transfer and capital gains are required to be calculated. I sold my building to another person. We have written agreement. Buyer paid me consideration. Buyer took my house. But buyer said registration we will do in next year. So legally the property is in my name till next year. Even though legally property is in my name, buyer will be considered as deemed owner, and I am required to calculate capital gains because all the three conditions of 53 of Transfer of Property Act are satisfied. Is it clear? Now, excludes. Transfer definition excludes. That means in all these cases, capital gains are not required to be calculated. If transaction is excluded from definition of transfer, capital gains are not required to be calculated. Any distribution of capital assets on total or partial partition of HUF. What do you mean by this? Ambani family is there. One fine day, Ambani family got divided. Okay. So Ambani distributed, Mukesh Ambani distributed all his assets to Akash Ambani, Anant Ambani and Isha Ambani. So whenever Hindu undivided family gets divided and assets of Hindu undivided family are distributed to small families, such distribution of assets from Hindu undivided family to small family is not a transfer and no capital gains are required to be calculated. Is it clear? Next. Transfer of capital asset by an individual or HUF. Please listen, this is an amendment which came in Finance Act 2024. Previously, transfer of capital asset by way of gift, will or inheritance is excluded from definition of transfer. There was a loophole. X Limited is a company. Y Limited is a company. X Limited gifted capital asset to Y Limited. If gift transaction is excluded from definition of transfer, capital gains are not required to be calculated, right? So no capital gains. this has become loophole. So to remove this loophole, in Finance Act number 2 of 2024, only if gift is given by individual or HUF, then only it is excluded from definition of transfer. I gave gift to another person. That gift transaction is excluded from definition of transfer. Partnership firm gave gift to a company. That is not excluded from definition of transfer. On that gift, capital gains are required to be calculated. Before 24-25, gift given by any person is excluded from definition of transfer. But with effect from Finance Act number 2024, which is applicable for previous year 24-25. That means this is a new point. If you have listened earlier classes, then this point you will not know, because this is the recent amendment which was made. So from 24-25 onwards, only if gift is given by individual or HUF, then only such gift is excluded from definition of transfer and capital gains are not required to be calculated. Is it clear? If gift is given by any other person, capital gains are required to be calculated. So any transfer by way of gift by an individual or HUF, or by way of will, or by way of an irrevocable trust, such a transfer is not considered as transfer and capital gains are not required to be calculated. Next, transfer of capital asset by holding company to its wholly owned Indian subsidiary company, or transfer of capital asset by subsidiary company to its 100% holding company. What do you mean by this? Reliance Limited is there, Jio Limited is there. Let's say Reliance Limited is holding company, Jio Limited is subsidiary company, and Reliance Limited holds 100% stake in Jio Limited. That means Jio Limited is 100% subsidiary of Reliance Limited. Here the thing is, whenever capital assets are transferred by holding company to 100% subsidiary company, or whenever capital assets are transferred by 100% subsidiary company to holding company, such a transfer of capital asset is not a transfer and no capital gains are required to be calculated. Is it clear? But only condition is the company which is receiving the capital asset, it should be an Indian company. In this case, Reliance Limited is Indian company, Jio Limited is also Indian company. So capital gains will not arise. So transfer of capital assets from holding company to subsidiary company, or subsidiary company to holding company, but holding company shall hold 100% stake in subsidiary company. In that case, transfer between these two entities is not a transfer and capital gains are not required to be calculated. Only one condition, recipient of capital asset, that company should be an Indian company. Next, transfer of capital assets by amalgamating company to amalgamated Indian company. So let's say two companies got merged, Idea and Vodafone. Both of them together formed a new entity called VI. So there will be transfer of capital assets from Vodafone to VI and Idea to VI. This transfer of capital assets is not a transfer and no capital gains are required to be calculated, subject to the condition amalgamated company must be an Indian company. Is it clear? So when amalgamated company is Indian company, transfer of capital assets from amalgamating company to amalgamated company or Vodafone to VI is not a transfer and no capital gains are required to be calculated. Is it clear? Now, there will be shareholders of Idea and shareholders of Vodafone. Now what VI will do? VI will issue shares to shareholders of Idea and it will give shares to shareholders of Vodafone, correct? In this case, exchange of amalgamating company shares. Now Idea company shareholders will surrender shareholders of Idea. Let's say I am shareholder of Idea, but Idea is not in existence. Idea is getting merged with Vodafone and forming a new company called VI. Now what I have done, I have surrendered Idea shares. In place of Idea shares, I have taken VI shares. That means what I am doing, I am exchanging idea shares with VI shares. So exchange of amalgamating company shares with amalgamated company shares is also not considered as transfer, and no capital gains are required to be calculated. Generally, if there is exchange of two capital assets, capital gains are required to be calculated. But if I exchange amalgamating company shares with amalgamated company shares, not a transfer and no capital gains are required to be calculated. Is it clear? Next. Transfer of capital asset by demerged company to resulting Indian company in a scheme of demerger. Let's say two companies got divided. Reliance Limited is there. Reliance Limited got divided. Reliance Limited got divided as Reliance Limited and Jio Limited, or Reliance Petroleum Limited. So previously Reliance Petroleum is part of Reliance Limited. Now for petroleum they created a separate company. So Reliance Limited got demerged as Reliance Limited and Reliance Petroleum Limited. Now Reliance Limited will transfer capital assets from Reliance Limited to Reliance Petroleum Limited. So this transfer of capital assets is not a transfer and no capital gains are required to be calculated. Are you able to understand? Simple. Now let's say Reliance Limited net worth is 100 crores. It transferred 40 crores to Reliance Petroleum Limited. After transfer, what is the net worth of Reliance Limited? Net worth of Reliance Limited will only be 60 crores. Correct? So in this scenario, I am the shareholder of Reliance Limited. My share price is 1000 rupees. 60% of my share is getting transferred to Reliance Petroleum Limited. So what Reliance Petroleum Limited will do? Reliance Petroleum Limited will give shares to shareholders of Reliance Limited. First point, in case of demerger, transfer of capital assets from demerged company to resulting company, Reliance Limited to Reliance Petroleum Limited, is not a transfer and no capital gains are required to be calculated. Not only that, shareholders of demerged company, they are losing 40% stake. For losing 40% stake in Reliance Limited, they are getting shares in Reliance Petroleum Limited. That means what? Issue of shares to demerged company shareholders by resulting company. Issue of shares by Reliance Petroleum Limited to shareholders of Reliance Limited. Even that issue of shares is also not a transfer and no capital gains are required to be calculated. See, they are losing 40%. For losing 40%, they are getting shares in Reliance Petroleum Limited. Even this exchange is also not considered as transfer and no capital gains are required to be calculated. Next. Government securities rupee denominated bonds outside India by a non-resident to another non-resident. Very simple. One non-resident is transferring capital asset to another non-resident. What is the capital asset? Capital asset is government security or rupee denominated bond. Where the transfer is happening? The transfer is happening outside India. The transaction is excluded from definition of transfer. Bretley or another person, Mitchell Stark, while playing in India, he purchased government securities. He went back to Australia. Stark sold government securities to Steve Smith in Australia. So Stark is a non-resident, Steve Smith is a non-resident. Government security is transferred. Where it is transferred? It is transferred in Australia, outside India. So it is not a transfer. Capital gains are not required to be calculated. Redemption of sovereign gold bonds. So if any sovereign gold bonds are redeemed, capital gains are not required to be calculated because redemption of sovereign gold bonds is not a transfer. Conversion of gold into electronic gold receipt or vice versa. I am having physical gold. I submitted physical gold. In place of physical gold, I took electronic gold receipt. So whenever you convert physical gold to electronic gold receipt, or whenever you reconvert electronic gold receipt to physical gold, such conversions are not considered as transfer and capital gains are not required to be calculated. Next, you can see conversion of preference shares to equity shares. Initially, I purchased preference shares. After 5 years, preference shares are redeemed, redemption of preference shares. So at the time of redemption, I did not take money. I converted my preference shares to equity shares. That means I am giving preference share, in place of preference share I am taking equity share. There is exchange of two capital assets, but it is not a transfer. No capital gains are required to be calculated. Transfer of capital asset under reverse mortgage. See, under reverse mortgage transaction, if any residential building is given to the banking company, that is not a transfer and no capital gains are required to be calculated. Next, whenever these assets, drawing, painting, sculpture, work of art, archaeological collections, if these are sold to government or any university notified by government, I am having a luxury painting in my home. If I sell this painting, I am required to calculate capital gains because painting is a capital asset. I did not sell to normal people. I sold the painting to government. Now I am not required to calculate capital gains because sale of painting to government is excluded from definition of transfer. Is it clear? Good. Next, let us discuss nature of capital asset. That means let us know how to classify a capital asset as long-term capital asset or short-term capital asset. Sir, why to classify, sir? Because for long-term capital gain there are separate tax rates. For short-term capital gain there are separate tax rates. So first we need to determine whether capital asset is long-term capital asset or short-term capital asset. If capital asset is long-term capital asset, then long-term capital gain or long-term capital loss will arise. If capital asset is short-term capital asset, then short-term capital gain or short-term capital loss will arise. There is amendment with regard to this nature of capital asset. Listen very carefully, you will understand. Before 23rd July 2024, there are three categories: first, second and third. That means capital assets are classified into three categories to determine whether they are long-term capital asset or short-term capital asset. For example, listed shares, listed securities other than units. That means what? Units listed in stock exchange, they are not covered under category 1, they are covered under category 3 before 23rd July 2024. Only listed securities are covered under category 1, listed units are not covered under category 1. Units of equity oriented mutual fund, units of UTI, zero coupon bonds. So 5 listed shares, listed securities other than units, units of equity oriented mutual fund, units of UTI, zero coupon bonds. These 5 assets are classified under category 1. For these 5 assets, if period of holding is less than or equal to 12 months, they are classified as a short-term capital asset. If period of holding is greater than 12 months, they are classified as long-term capital asset. Next, category 2, unlisted shares, land or building or both. That means what? Whenever you are transferring unlisted company equity shares or preference shares, or whenever you are transferring immovable property, unlisted shares, immovable property, these two has fallen under category 2. So if they fall under category 2, criteria is 24 months. If period of holding is less than or equal to 24 months, classified as short-term capital asset. If period of holding is greater than 24 months, classified as long-term capital asset. Is it clear? Next, those capital assets which are not covered under category 1 and category 2 are there, remaining all will fall under category 3. Listed units, they are not covered under category 1, they are also not covered under category 2. So listed units will fall under category 3. So whatever the capital asset not covered under category 1, category 2, remaining all will fall under category 3. Criteria is 36 months. So for category 3 capital assets, if period of holding is less than or equal to 36 months, classified as short-term capital assets. If period of holding is greater than 36 months, classified as long-term capital assets. My dear students, please remember, before 23rd July 2024, for classification of capital assets, 3 categories are there. However, on or after 23rd July 2024, there are only 2 categories to classify whether a capital asset is as long-term capital asset or short-term capital asset. Are you able to understand? So before 23rd July, to classify a capital asset as long-term capital asset or short-term capital asset, how many categories are there? 3 categories are there. On or after 23rd July 2024, to classify a capital asset as long-term or short-term, there are only 2 categories. Okay, that is the major amendment. Before, up to 36 months, asset can be a short-term capital asset. but on or after 23rd July 2024 up to 24 months if asset is held, then that asset can be a short-term capital asset. But if a capital asset is held for more than 24 months, on or after 23rd July 24, if asset is held for more than 24 months, that asset is a long-term capital asset. So before 23rd July, 36 months concept is there. After 23rd July, 36 months is there, either 12 months or 24 months. Are you able to understand? Now, on or after 23rd July 2024, listed shares, listed securities, including units. That means what? Listed units are there. If they are transferred before 23rd July, the criteria is 36 months. If listed units are transferred on or after 23rd July 24, criteria is 12 months. Is it clear? So if listed units are transferred on or after 23rd July 24, you have to consider 12 months. So if period of holding of those listed units is below 12 months, classified as short-term capital asset. If period of holding of those listed units is above 24 months, above 12 months, classified as long-term capital asset. Is it clear? Next, units of equity oriented fund, units of UTI, zero coupon bonds. Whatever category 1 before 23rd July is there, same category 1 after 23rd July also. Only amendment, only change is listed units are also included in category 1. Previously listed units are not covered under category 1, they are covered under category 3. On or after 23rd July 2024, listed units are also covered under category 1. Is it clear? So listed shares, listed securities including units, units of equity oriented mutual fund, units of UTI, zero coupon bonds. For these 5 capital assets, they are all classified under category 1. If period of holding is less than or equal to 12 months, they are classified as short-term capital asset. If period of holding is greater than 12 months, they are classified as long-term capital asset. Those capital assets which are not covered under category 1 are there. Remaining every capital asset will fall under category 2. There are only 2 categories. So for remaining all capital assets other than these 5 assets, how many are covered under category 1? 5. Listed shares, listed securities including units, units of equity oriented mutual fund, units of UTI, zero coupon bonds. For these 5 capital assets, criteria is 12 months. For remaining all capital assets, criteria is 24 months. There are only 2 categories on or after 23rd July 24. So remaining all capital assets, if they are held for 24 months, classified as short-term capital asset. If they are held for more than 24 months, classified as long-term capital asset. Is it clear? Next. See, there are some capital assets. These capital assets are always treated as short-term capital assets. That means for these 3 capital assets, you need not check period of holding. You are not required to check period of holding. Straight away you can tell these capital assets are short-term capital assets. What are they? Market linked debentures. Market linked debentures are always considered as short-term capital assets. Units of specified mutual fund acquired on or after 1st April 23. So you are purchasing units of a specified mutual fund. If you purchase before 1st April 23, then it can be long-term capital asset or short-term capital asset. But if you are purchasing units of specified mutual fund on or after 1st April 23, they are always considered as short-term capital asset irrespective of period of holding. Next. On or after 23rd July 2024, this is also amendment. Actually, units of specified mutual fund acquired on or after 1st April 23, market linked debentures. These 2 are capital assets covered under section 50AA. For section 50AA, another amendment was also made. Previously, there are only 2 capital assets covered under 50AA. Now 3 capital assets are covered under 50AA. Unlisted debentures and unlisted bonds are also included in section 50AA. That means on or after 23rd July 2024, section 50AA covers 3 capital assets. What is section 50AA? We will see little later. Have patience. So, unlisted bonds and unlisted debentures, those are also included in definition of, those are also included in section 50AA. Only unlisted debentures and unlisted bonds transferred on or after 23rd July 2024, they are only included in section 50AA. That means unlisted bonds, unlisted debentures, if they are transferred before 23rd July 2024, they can be either long-term capital asset or short-term capital asset. But unlisted debentures bonds transferred on or after 23rd July 2024, they are always considered as short-term capital asset. Is it clear? So, for capital assets always considered as short-term capital assets. Whenever you see these 4 capital assets, don't calculate period of holding. Straight away you can tell short-term capital asset. What are those 4 capital assets? First, market linked debentures. Second, units of specified mutual fund which are acquired after 1st April 23. Next, unlisted debentures, unlisted bonds. These two, if they are transferred on or after 23rd July 24, they are considered as short-term capital assets irrespective of period of holding. Is it clear? Now, in the previous concept, quite often we discussed about period of holding. If period of holding is less than or equal to 12 months, if period of holding is greater than 12 months, greater than 24 months, like that. Sir, what do you mean by this period of holding? How to calculate period of holding? See, period of holding is always calculated from date of purchase up to the date prior to the date of transfer. I purchased one building on 9th July 2016. I sold the building on 8th February 2020. Now, period of holding will be calculated from 9th July 2016 to 7th February 2020. Are you able to understand? So, period of holding will be calculated from date of purchase up to the date prior to the date of transfer. Are you able to understand? Very simple. On 8th February 2020, I am selling my building to Mr. A. So, Mr. A is the owner on 8th February 2020. I am the owner till 7th February 2020 only. That's why period of holding will be calculated from date of purchase up to the date prior to the date of transfer. Date of transfer 8th February 2022 should not be considered in calculation of period of holding. So, period of holding is always calculated from date of purchase up to the date prior to the date of transfer. Don't calculate it till 8th February. Date of transfer should not be considered in period of holding. Period of holding will be calculated from date of purchase up to the date prior to the date of transfer. Is it clear? Good. Special cases. Generally, how we calculate period of holding? We will calculate period of holding from date of purchase up to the date prior to the date of transfer. But there are some special cases. Let us see now. Shares purchased from primary market. I wanted to purchase Reliance Limited shares. Reliance Limited shares are already listed on stock exchange. So from stock exchange I will directly purchase. I wanted to purchase shares of A Limited which is not listed in stock exchange. So A Limited shares not listed in stock exchange. How can I purchase? Now I have to purchase directly from company. So whenever shares are purchased directly from unlisted company, that transaction we call as shares purchased from primary market. So I kept application to the company on 10th February. I want 100 shares. Company allotted me shares on 15th February. In this case, period of holding should not be calculated from date of application. Period of holding should be calculated from 15th February, date of allotment. Because when I keep the application, company may accept the application or company may reject the application. I do not know whether I can be the owner of shares of A Limited. But on 15th February, company allotted me shares. So the date on which company allotted shares to me, on that day I am the owner of shares. There is guarantee. So there is security. So from 15th February onwards, I have to calculate the period of holding. So whenever you are purchasing shares directly from primary market, don't calculate period of holding from date of application. Calculate period of holding from date of allotment. Is it clear? Next, for bonus shares, sweat equity shares, for right shares. For these shares also, like period of holding is required to be calculated from date of allotment. So in 4 cases, period of holding is required to be calculated from date of allotment. What are they? Shares acquired in primary market, bonus shares, right shares, sweat equity shares. For these 4 cases, period of holding will be calculated from date of allotment up to the date prior to the date of transfer. Date of allotment up to date prior to date of transfer. So did you understand? Next, conversion of preference shares into equity shares. So whenever I convert the preference shares into equity shares, then period of holding is equal to period of holding of current capital asset plus period of holding of previous capital asset. I will tell with one example so you will understand better. On 2nd June 2018, I purchased preference shares. Preference shares are issued for 3 years. So on 2nd June 2021, company gave me an option. I can give preference shares and I can take money. So at the time of redemption of preference shares, I can take money. Second option, company gave me a choice. I can convert preference shares to equity shares. I chose second option. So on 2nd June 2021, I converted preference shares into equity shares. On 9th December 2022, I sold equity shares. Now, initially I purchased preference shares. Later on, preference shares got converted into equity shares. At the end, I sold equity shares. That means whatever the capital asset that I am selling, whatever the capital asset that I am transferring, that is not the capital asset that I have purchased. I am selling equity shares, but I did not purchase equity shares. I purchased preference shares, they got converted into equity shares, and ultimately I sold equity shares. So in this case, whenever one capital asset is converted into another capital asset, whenever preference share is converted into equity share, then period of holding of equity share is equal to period of holding of equity share plus period of holding of preference share. Do you agree with me? This is period of holding of equity share. Yes, this is period of holding of preference share. So whenever equity shares are sold, period of holding is equal to period of holding of equity share plus period of holding of preference share. So that's what period of holding of current capital asset plus period of holding of previous capital asset. So in all these cases, the scenario is same from 1 to 6. Initially, one capital asset is purchased, that capital asset is converted into new capital asset and new capital asset is sold. So period of holding of new capital asset is equal to period of holding of new capital asset plus period of holding of previous capital asset. Are you able to understand? So whenever preference shares are converted into equity shares and equity shares are sold, period of holding of equity shares is equal to period of holding of equity shares plus period of holding of preference shares. So in all these cases, gold is converted into electronic gold receipt. I have 1 kg of gold. I have submitted. I took 1 kg electronic gold receipt. Tomorrow I sold electronic gold receipt. Period of holding of electronic gold receipt is equal to period of holding of electronic gold receipt plus period of holding of physical gold. Are you able to understand? So in these 6 cases, period of holding is equal to period of holding of current capital asset plus period of holding of previous capital asset. Next, rights renouncement. What do you mean by this? You know right renouncement, right? I have, for example, 10 shares in Infosys Limited. Now Mr. Narayan Murthy is not chairman of Infosys. I am not interested in purchasing Infosys shares. I am thinking of selling these 10 Infosys shares. Now Infosys on 2nd February 25 gave right offer. Given rights offer. 2 shares for 10 shares. I have 10 shares, right? So I have rights offer for two shares. Market price is 120 rupees, right price is 70 rupees. I am thinking of selling existing 10 Infosys shares with me. Why will I purchase another 2 shares of Infosys? I will not purchase, right? But there is my friend with the name Abhinav. Abhinav came to me and told me, anyhow you are not thinking to purchase right shares in Infosys. So whatever the rights offer that you got, renounce it to me. So what happens if I renounce my right to Abhinav? I am having right. I can purchase 2 shares of Infosys only for 70 rupees. If I go to market, I need to pay 120. But if I purchase directly from rights share, I need to pay only 70 rupees. So what happened in this case? I transferred my right to Abhinav. That means I am renouncing my right. I am giving up my right. I am giving this right to Abhinav. So as I am renounced, Abhinav paid me 20 rupees. Abhinav paid 20 rupees. What is benefit to Abhinav? Abhinav, by paying 20 rupees, he purchased right. Using this right, he will purchase Infosys share only for 70 rupees. So 70 plus 20, what is cost to Abhinav? Cost to Abhinav is 90 rupees only. If he goes to stock exchange, he need to pay 120 rupees. By purchasing right from me, he is purchasing it only for 90 rupees. That is benefit to Abhinav. This is win-win situation. I don't want Infosys shares. I got right. I sold right for 20 rupees. I am benefited. 20 rupees came to me. Abhinav, he wants to purchase Infosys shares. If he goes to stock exchange, he need to pay 120 rupees. So he purchased right from me for 20 rupees and purchased right share for 70 rupees. So total cost to him is 90 rupees. So this is win-win situation. In this case, I am having right. Right is an intangible asset. It is a capital asset. This right I am selling to Abhinav for 20 rupees. So that 20 rupees is capital gains to me. Are you able to understand? This is capital gains to me. But whether it is long-term capital asset or short-term capital asset, I do not know, right? So for that, we have to calculate period of holding to tell whether it is long-term capital asset or short-term capital asset. I renounced on 10th February 2025. So in this case, period of holding is equal to 2nd February 25 to 10th February 25. So whenever rights are renounced, in that case period of holding is equal to date of offer. When offer was given to me, 2nd February, date of offer to date of renouncement. Are you able to understand how many days? 9 days. Correct. Period of holding is equal to 9 days. In case of right renouncement, period of holding shall be calculated from date of offer of such shares by the company to the date of renouncement. Is it clear? Good. Property acquired in any mode given under section 49(1). If individual gives gift, that is excluded from definition of transfer, right? So there are certain cases. For example, I am there, Uma. I gave gift to Satish. There is one gold bracelet with me, purchased on 7th July 2018. This gold bracelet I gifted to Satish. Let's say gold bracelet worth is 40,000 rupees. For example, it's not 40,000, it's more than that. Worth of gold bracelet is 40,000 rupees. When I gifted on 8th August 2022. Satish sold gold bracelet on 9th February 2023. So who is required to calculate capital gains? First tell me whether this transaction is transfer. This transaction is not a transfer. No capital gains are required to be calculated. Why? Because gift is not a transfer if gift is given by individual. But this is transfer, right? And capital gains are also required to be calculated. While calculating capital gain, you have to know whether it is long-term capital asset or short-term capital asset. How do we know? We have to calculate period of holding. So here, period of holding is equal to period of holding of Satish plus period of holding of Uma. That means what? Whenever individual gives gift to another person, that is excluded from definition of transfer. So in the hands of new owner, so who is new owner? New owner is Satish. So in the hands of new owner, whenever he sells that gift, period of holding is equal to period of holding of current owner Satish plus period of holding of previous owner Uma. Are you able to understand? So there are certain exceptions to definition of transfer. Transfer of capital assets by Hindu undivided family to small family. Transfer of capital assets by way of gift given by individual or will or inheritance. Transfer of capital assets from holding company to 100% subsidiary company or 100% subsidiary company to holding company. Transfer of capital assets from amalgamating company to amalgamated company. Transfer of capital assets from demerged company to resulting company. All these are excluded from definition of transfer. Whenever these are excluded from definition of transfer, capital asset is transferred from old owner to new owner and capital gains are not required to be calculated by old owner. So in the hands of new owner, whenever he sells that gift, period of holding in the hands of new owner is equal to period of holding of current owner plus period of holding of previous owner. Current owner Satish, previous owner Uma. Are you able to understand? So exceptions to definition of transfer. In those cases, period of holding of new owner is equal to period of holding of new owner plus period of holding of previous owner. Next, conversion of stock in trade into capital asset. Whenever stock in trade is converted into capital asset, let's say my main business is gold business. On 2nd June 2017, I purchased gold ring. Whenever in business gold ring is purchased, it is stock in trade, right? On 8th March 2022, that gold ring is not purchased by anyone. So I thought I will wear that gold ring. So whenever I am wearing that gold ring for my personal purpose, I am converting stock in trade into capital asset, correct? So whenever I convert stock in trade into capital asset, we have to take fair market value. On this day, see, gold ring is purchased for 20,000. But on the date of conversion, fair market value is 27,000. On 9th June 2024, this gold ring is sold for 32,000 rupees. In this case, for this period, it is stock in trade. For this period, it is capital asset. When I sold gold ring, I sold gold ring on 9th June 2024. So in this case, period of holding is equal to 8th March 2022 to 8th June 2024. So whenever stock in trade is converted into capital asset, period of holding will be calculated from date of conversion. What is date of conversion? Date of conversion is 8th March 2022. Period of holding will be calculated from date of conversion up to the date prior to the date of transfer. So date of transfer is 8th June. Prior to the date of transfer is 9th June. Prior to the date of transfer means 8th June. So in case of conversion of stock in trade into capital asset, period of holding will be calculated from date of purchase up to the date prior to the date of date of conversion up to the date prior to the date of transfer. Whenever company is liquidated, I purchased shares of Kingfisher Limited. I purchased these shares on 8th June 2016. On 9th June 2020, Kingfisher liquidated. Whenever company is liquidated, I will surrender my shares. For surrendering my shares, I will get money. I got money on 6th June 2024. In this case, period of holding will be calculated from date of purchase up to the date of liquidation. Whatever the period after the date of liquidation is there, that should not be considered in calculation of period of holding. Period of holding will be calculated from date of purchase till the date of liquidation. Whatever the period after the date of liquidation is there, that should not be considered in calculation of period of holding. Is it clear? Hope period of holding concept is very clear for you. Now let us discuss format for computation of capital gains. With regard to depreciable capital assets, how capital gains are required to be calculated, that is to be discussed separately in depreciation video. I am going to make one video on depreciation. In that video only, capital gains in case of depreciable capital assets will also be discussed. In case of non-depreciable capital assets, if it is short-term capital asset, first we will take full value of consideration. Whatever the sale consideration is there, that is full value of consideration. From that we will reduce transfer expenses. Thereby we will arrive at net consideration. From that we will reduce cost of acquisition and cost of improvement. Thereby we will arrive at gross short-term capital gain. From that we will claim exemptions. Thereby we will arrive at net short-term capital gain. In case of long-term capital gains, if transfer takes place before 23rd July 2024, amendment is there, listen carefully. Full value of consideration, we will reduce transfer expenses, thereby we will arrive at net consideration. We will reduce indexed cost of acquisition and indexed cost of improvement. Using index numbers, we will calculate indexed cost of acquisition. Indexation benefit is available only for long-term capital assets. For short-term capital assets, indexation benefit is not available. That's why we have considered only cost of acquisition and cost of improvement. For long-term capital assets, indexation benefit is available. That's why we have considered indexed cost of acquisition and indexed cost of improvement. Thereby we will arrive at gross long-term capital gain. From that we will reduce exemptions. Thereby we will arrive at not net long-term capital gain. If transfer takes place on or after 23rd July 2024, major amendment. In Finance Act number 2 of 2024, on or after 23rd July 2024, if any capital asset is transferred, indexation benefit is not available. So if capital asset is transferred after 23rd July 2024, you should not claim indexed cost of acquisition, you should claim only cost of acquisition and cost of improvement. Is it clear? So just like how we calculate capital gains for short-term capital asset, in the same way only we have to calculate capital gains for long-term capital asset also, if that long-term capital asset is transferred on or after 23rd July 2024. Generally for long-term capital assets, indexation benefit is available. But if long-term capital asset is transferred on or after 23rd July 2024, indexation benefit is not available. So first, let us discuss how to calculate full value of consideration. See what consideration means, something in return. So if anything is received in return for transfer of capital asset, whatever the consideration that is received in return is there, that we call as full value of consideration. Whatever the consideration that is received for transfer of capital asset is there, that consideration can be either monetary or non-monetary. I am selling building. Now for sale of building, I can receive cash or I can receive any other asset. That means whenever you are selling capital asset, consideration can be in cash or consideration can be in kind. If consideration is in kind, fair market value of kind received is to be taken as full value of consideration. What do you mean by this? I am selling building. In return, I got agricultural land. That means what? For sale of building, in return I am getting agricultural land. Whatever the fair market value of agricultural land is there, that is to be taken as full value of consideration. So if consideration is received in the form of kind, then fair market value of kind received is to be taken as full value of consideration. Sometimes whatever the kind that is received is there, that is not ascertainable. If kind received is not ascertainable, then fair market value of capital asset transferred is to be taken as full value of consideration. Is it clear? That's it. Next, transfer expenses. See, To transfer capital asset, if any expenditure is exclusively incurred, that expenditure we call as a transfer expenditure, and transfer expenditure is a deductible expense. We will reduce transfer expense from full value of consideration. I wanted to sell my building. I gave advertisement. So whatever the advertisement that I gave, that is solely for the purpose of selling this building. So that advertisement expenditure I can claim as deduction. It is transfer expenditure. I went to an agent. I told the agent, if you sell this building, 1% I will give you as a commission. So he sold this building. I paid 1% as commission. Why I paid commission? With regard to sale of this building. That commission is transfer expense and it can be reduced. So any expenditure which is incurred exclusively for the purpose of transfer is there, that we call as transfer expense, that can be reduced from full value of consideration. But in case of sale of shares or securities, if securities transaction tax is paid, STT is not allowed as transfer expenditure. STT paid is not allowed as a transfer expenditure. So we finished discussing about full value of consideration. We also discussed about transfer expenses. Now let us discuss about cost of acquisition. Sir, how to calculate cost of acquisition? Cost of acquisition is equal to purchase cost plus incidental expenses. What do you mean by this? I purchased one land. Land is a capital asset, right? But to purchase that land, I have paid stamp duty. I have paid registration charges. All the stamp duty and registration charges I paid only for the purpose of purchase of land. So I purchased land for 80 lakh rupees. Stamp duty is 10 lakhs. Registration charges are 3 lakhs. Now cost of acquisition is purchase cost of land is 80 lakhs plus stamp duty 10 lakhs, registration charges 3 lakhs. So total cost of land is 93 lakhs. So for the purpose of calculation of capital gains, cost of land is not 80 lakhs, cost of land is 93 lakhs. So cost of acquisition is equal to purchase cost plus incidental expenses. See, till the asset is put to use, whatever the expenses that are incurred with regard to that capital asset are there, incidental expenses, they are also required to be added to the cost of the asset. So cost of acquisition is equal to purchase cost plus incidental expenses. There is an amendment. You know interest on house property, right? For example, on 1st April 2024, I took housing loan. I purchased a house on 1st July 24. That means during these 3 months, I paid interest of 60,000 rupees. I have two options. This is pre-construction period interest, right? Or this is current year interest. If this interest amount, if I claim as deduction under section 24B, then can I add it to cost of acquisition? I cannot add it to cost of acquisition. Generally, there is a loophole. From date of taking loan up to the date when asset is purchased, whatever the interest is there, SSC is claiming that interest as expenditure under section 24B, and SSC is also adding interest amount to cost of the asset. That means 2 times expenditure he is claiming as deduction. One time he is claiming as deduction under section 24B. Second time, same interest amount he is adding to the cost of the house. So whenever asset is sold, cost of house is allowed as deduction. That means second time also he is claiming as deduction. That's why this rule they introduced. Once you claim interest on capital asset as deduction under section 24B, same interest amount you cannot add it to the cost of acquisition. Is it clear? Next, special cases. See, bonus shares. Generally, bonus shares are given at free of cost. But if bonus shares are allotted by company before 1st April 2001, then cost of acquisition is equal to fair market value as on 1st April 2001. Bonus shares allotted before 1st April 2001. Cost of acquisition is equal to fair market value as on 1st April 2001. bonus shares allotted after 1st April 2001. Cost of acquisition is equal to nil. Is it clear? Because after 1st April 2001, generally bonus shares are allotted at free of cost. That's why cost of acquisition for bonus shares is 0. However, if bonus shares are allotted before 1st April 2001, fair market value benefit is there. That's why if bonus shares are allotted before 1st April 2001, cost of acquisition is equal to fair market value as on 1st April 2001. Intangible assets. See, if intangible assets are self-generated, then cost of acquisition is equal to nil. If intangible assets are purchased, then cost of acquisition is equal to purchase cost. If intangible asset is goodwill and I purchased goodwill, let's say I wanted to run a hotel. There is a hotel with the name Novotel. I wanted to use the name of that word Novotel. I asked Novotel to use the name Novotel for my hotel as well. So Novotel is basically selling goodwill to me. For that goodwill, I paid 10 lakh rupees. So if any goodwill is purchased, then cost of acquisition of goodwill is equal to purchase cost minus depreciation till previous year 1920. See, from 1920 onwards, depreciation is not allowed on goodwill. So that's why cost of goodwill is equal to purchase cost minus depreciation that is allowed till previous year 1920. Let's say I purchased it for 10 lakhs in 1819. Okay, in 1819, 25% depreciation is allowed. So 10 lakhs minus depreciation 2.5 lakhs, 25%. So what is the balance? 7,50,000. That 7,50,000 is opening balance as on 1st April 1920. 7,50,000 will be considered as cost of goodwill. Because from 1920 onwards, I am not required to calculate depreciation. So from 1920 amendment came, depreciation should not be calculated on goodwill. So if any goodwill is purchased before 1st April 1920, in such case, in 1819 I purchased goodwill for purchase cost is 10 lakhs. I provided depreciation. How much? 25%, 2.5 lakhs. So as on 1st April 2019, what is written down value? Written down value is 7.5 lakhs. This is to be taken as cost of acquisition on sale of goodwill, because on or after 1st April 2019, no depreciation is to be provided for goodwill. So as on 1st April 2019, whatever the written down value is there, that is to be taken as cost of acquisition in case of goodwill. Is it clear? Next, sweat equity shares or specified shares. If you remember, in this booster series only, I have explained one chapter, salaries. In salaries, I have told whenever sweat equity shares are issued, how much is taxable value? Taxable value is equal to market value on date of exercise of option minus amount paid by employee. Do you remember? Let's say Reliance Limited gave sweat equity shares. Market price on the date of exercise of the option is 180 rupees. But employee is required to pay only 20 rupees. Now how much is benefit received by employee? 160 is benefit received by employee. This 160 rupees is taxable to the employee under the head salaries. Tomorrow this employee will sell the sweat equity share, right? Let's say tomorrow this employee sold sweat equity share for 270 rupees. So how much is full value of consideration? 270 rupees. Now you need to claim cost of acquisition, right? How much is cost of acquisition? Cost of acquisition is 180 rupees. Because 20 rupees he paid from his pocket, on 160 rupees he paid tax under the head salaries. So whatever the fair market value on the date of exercise of option is there, that is allowed as cost of acquisition, and capital gain will be 90 rupees. Is it clear? So whenever sweat equity shares are allotted, cost of acquisition of sweat equity shares is equal to fair market value of shares on the date of exercise of the option. Right renouncement. I have told one example. Infosys allotted me right. I sold the right to Abhinav for 20 rupees. Did I purchase right? I did not purchase right. As I am already the existing shareholder, Infosys freely gave me right. So whenever I am selling the right in the hands of transferor of right, cost of acquisition is 0. In the hands of transferee, in the hands of Abhinav purchased right for 20 rupees. So in the hands of Abhinav, in the hands of transferee, value of right is equal to amount paid to company plus amount paid to renouncer. See, he paid 20 rupees to me and he paid 70 rupees to the Infosys. So cost of acquisition in the hands of Abhinav is 90 rupees. Are you able to understand? See, in these cases, conversion of preference shares to equity shares, conversion of bonds, debentures, debenture stock or deposit certificates into shares or debentures, conversion of gold into electronic gold receipt into gold, exchange of amalgamating company shares for amalgamated Indian company shares. In all these cases, cost of acquisition is equal to cost of previous capital asset. What do you mean by this? I gave this example of preference shares and equity shares, right? Let's say here I purchased preference shares for 1 lakh. I sold equity shares for 2,80,000, 2.8 lakhs. In this case, what am I selling? I am selling equity shares. I sold equity shares for 2,80,000. But did I purchase equity shares? I did not purchase equity shares. Actually, I purchased preference shares. Later on, preference shares got converted into equity shares, and in future, I am selling equity shares. So, in case of conversion happening, and if the new capital asset is sold, cost of new capital asset is equal to cost of previous capital asset. Here what is sold? Equity share. So cost of equity share sold is equal to cost of preference share 1 lakh rupees. Are you able to understand? So I sold for 2.8 lakhs. Cost of acquisition is 1 lakh. Capital gains will be 1.8 lakhs. Is it clear? So whenever in case of conversion of preference shares into equity shares, ultimately you are going to sell equity shares, but you are not purchasing equity shares. So on sale of equity shares, cost of acquisition is equal to cost of preference shares. Is it clear? Good. So in all these cases, in these 5 cases, actually initially you are purchasing one capital asset. Later on that capital asset is getting converted into new capital asset and you are selling new capital asset. So on sale of new capital asset, cost of acquisition is equal to cost of old capital asset or cost of previous capital asset. Conversion of stock in trade into capital asset. See, I gave example. Gold business. So in gold business, what I did, I converted gold ring. I converted gold ring being stock in trade into capital asset. So on this date, fair market value is 27,000, right? So this 27,000 is to be taken as cost of acquisition on calculation of capital gains. I sold it for 32,000. So full value of consideration is equal to 32,000. Cost of acquisition is equal to fair market value on the date of conversion. Capital gain will be 5,000. Is it clear? So in case of conversion of stock in trade into capital asset, fair market value on the date of conversion is to be taken as cost of acquisition. Assets acquired by any modes specified under section 49(1). Nothing but exceptions to transfer. Transfer of capital assets by Hindu undivided family to small family, gift, will or inheritance, transfer of capital assets from holding company to 100% subsidiary company or 100% subsidiary company to holding company, transfer of capital assets from amalgamating company to amalgamated company or amalgamated Indian company to, transfer of capital assets from demerged company to resulting company. In all these cases, asset was previously owned by one person, but he is transferring to new person. But the transfer is not a transfer. Okay, I own a asset, building. I gifted to Satish. Okay, now building is sold by Satish. Whether Satish purchased the building, Satish did not purchase the building. I purchased the building. So in the hands of Satish, on sale of building, cost of acquisition is equal to cost of acquisition in the hands of Umasankar. Are you able to understand? So whatever the exceptions to definition of transfer are there, in those situations, cost of acquisition is equal to cost in the hands of previous owner, because whenever capital asset is transferred from A to B and that transaction is excluded from definition of transfer, capital gains are not required to be calculated. So in the hands of transferee, whenever that asset is sold, cost of acquisition in the hands of transferee is equal to cost of acquisition in the hands of transferor. Nothing but cost of acquisition in the hands of new owner is equal to cost of acquisition in the hands of previous owner, where cost of property in the hands of previous owner cannot be ascertained. I gave building to Satish. I do not know purchase cost. At what price I purchased the building. In that case, that means in the hands of transferee, cost of previous owner is not ascertainable. Then fair market value on the date on which capital asset became property of the previous owner would be considered as cost of acquisition. For example, on 7th January 2018, I purchased a building. Let's say I do not know the value of the building is not known. I gave this building as a gift on 6th June 2020 to Satish. Now in the hands of Satish, cost of acquisition. What is cost of acquisition? Cost of acquisition is equal to fair market value as on 7th January 2018. Is it clear? Property acquired by way of gift. My friend gifted me a gold chain. Value of gold chain is 45,000. You know, under the head other sources, if value of gift is less than 50,000, it is not taxable. So 45,000 worth of gold chain is gifted to me. It is not taxable to me because value of gift is less than 50,000. I sold this gold chain. On sale of this gold chain, I am required to calculate capital gains, right? I did not purchase the gold chain. My friend purchased the gold chain. So in my hands, cost of acquisition is equal to cost in my friend's hand. 45,000 is to be taken as cost of acquisition. So if gift is not taxable under other sources, cost of acquisition is equal to cost to previous owner. Second case, my friend gifted me a gold bracelet. Cost of gold bracelet is 2,30,000 rupees. Now 2,30,000 is taxable to me under the head other sources. I sold this gold bracelet for 2,80,000 rupees. Now I did not purchase gold bracelet, right? In my hands, cost of acquisition is equal to cost of previous owner. At what price my friend purchased the bracelet? 2,30,000. That is to be taken as cost of acquisition. Why that is to be taken as cost of acquisition? 2,30,000 is taxable to me under the head income from other sources. See, what is the value of gold bracelet? 2,30,000. Its value is greater than 50,000, right? So this is taxable to me under the head income from other sources. Now whatever this 2,30,000 is there, this is to be taken as cost of acquisition on sale of gold bracelet. So whenever gift is taxable, in such case, whatever the fair market value, see on the date on which gift is given to me, on this date fair market value of that gift is 2,30,000. That is to be taken as cost of acquisition. So whenever gift is taxable, cost of acquisition is equal to fair market value in case of movable property, stamp duty value in case of immovable property. Very simple. Value of gift is less than 50,000, not taxable under other sources. So cost of previous owner we will take. Value of gift is taxable under other sources. So under other sources, whatever the amount that is taxable is there, whatever the fair market value that is taxable is there, such fair market value we will take as cost of acquisition. Now let us discuss fair market value as on 1st April 2001. See, if capital asset is purchased before 1st April 2001, then cost of acquisition is equal to fair market value or actual cost, whichever is higher in case of movable asset. Let's say for example, in 1999, gold was purchased. Actual cost is 20,000. On 1st April 2001, fair market value of the gold is equal to 30,000. So cost of acquisition of gold, see when it was purchased at 1999, that means before 1st April 2001, right? And gold is a movable asset. Whenever movable capital asset is purchased before 1st April 2001, cost of acquisition of such capital asset is equal to actual cost or fair market value as on 1st April 2001, whichever is higher. So actual cost here is 20,000. Fair market value is 30,000. Whichever is higher means 30,000 is to be taken as cost of acquisition of gold. If capital asset is immovable asset, then benefit will be calculated in 3 steps. I will tell one example. Building purchased in 1995. Actual cost is 2 lakhs. On 1st April 2001, stamp duty value is 4 lakhs. Fair market value is 4,50,000. Building is a immovable asset and it is purchased before 1st April 2001. Am I correct or not? So in this case, cost of acquisition will be calculated in 3 steps. Step 1, stamp duty value or fair market value as on 1st April 2001, whichever is lower. Stamp duty value 4 lakhs, fair market value 4.5 lakhs, whichever is lower means 4 lakhs. Step 2, actual cost. How much is actual cost? 2 lakhs. Step 3, cost of acquisition is equal to step 1 or step 2, whichever is higher. 4 lakhs or 2 lakhs, whichever is higher means 4 lakhs is to be taken as cost of acquisition. So if immovable capital asset is purchased before 1st April 2001, cost of acquisition will be calculated in 3 steps. Step 1, stamp duty value or fair market value, whichever is lower. Step 2, actual cost. Step 3, cost of acquisition is equal to step 1 or step 2, whichever is higher. Next, cost of improvement. After purchasing the capital asset, if any capital expenditure is incurred for the improvisation of capital asset, that we call as improvement cost. I purchased one building, it has only one floor. I purchased it for 10 lakhs. Next, what I did, I constructed second floor. Now construction of second floor is a capital expenditure and it is incurred on building that I have purchased. That means whatever the first floor building that I have purchased, I am improving it by constructing second floor. Now whatever the expenditure for second floor is there, that is cost of improvement. Is it clear? So it means any capital expenditure incurred by SSC in making any additions or improvement to the capital asset. So for making any additions, if any extra capital expenditure is incurred, that we call as cost of improvement. Even cost of improvement is also allowed as deduction. For example, I got building as a gift, but cost of improvement is incurred by previous owner. Even cost of improvement incurred by previous owner is also allowed as deduction to me. That means what? Cost of improvement can be incurred either by SSC or previous owner. Either by SSC or previous owner. And cost of improvement is available for both tangible as well as for intangible assets. See, we have seen fair market value as on 1st April 2001. This benefit is available only for tangible capital assets. For intangible capital assets, fair market value as on 1st April 2001 is not available. That means for intangible capital assets, cost of acquisition is equal to actual cost even though it is purchased before 1st April 2001, because fair market value benefit as on 1st April 2001 is not available for intangible assets. However, for cost of improvement, intangible assets also can claim. That means what? For intangible assets, cost of improvement benefit is available. However, fair market value as on 1st April 2001, that benefit is not available. cost of improvement incurred on or after 1st April 2001 is allowed as deduction. What do you mean by this? If cost of improvement is incurred before 1st April 2001, such cost of improvement is not allowed as deduction. Only cost of improvement incurred on or after 1st April 2001 is only allowed as deduction. For intangible assets, fair market value benefit is not available. Cost of improvement benefit is not available. Cost of improvement benefit is available. So cost of improvement incurred before 1st April 2001 is to be ignored. For goodwill, right to manufacture any article or thing, right to carry on any business. Generally, for intangible assets, indexation benefit is available. However, if intangible assets are goodwill, right to manufacture any article or thing, or right to carry on any business, cost of improvement is not available. Are you able to understand? Cost of improvement is available for both tangible and intangible assets except goodwill, right to manufacture any article or thing, or right to carry on any business. Next, indexation. If long-term capital asset is transferred before 23rd July 24, why? Because on or after 23rd July 24, if long-term capital asset is transferred, indexation benefit is not available. So only if capital asset is transferred before 23rd July 2024, indexation benefit is available. So whenever capital asset is transferred before 23rd July 24, you can claim indexed cost of acquisition. For example, I purchased a building on 1st April 2014 for rupees 10 lakhs. I sold building on, let's say this building is purchased by A Limited. Sold building on, say some date, 4th April 2024. Now obviously period of holding for 24-25, right? Period of holding is greater than 24 months. So it will be classified as long-term capital asset. Building is a long-term capital asset. So for building we can claim indexation benefit. I sold for 27 lakhs. Full value of consideration will be 27 lakhs. Less, it is long-term capital asset and it is transferred before 23rd July 24. As it is transferred before 23rd July 24, in place of cost of acquisition, I can claim indexed cost of acquisition. Formula is cost of acquisition into cost inflation index in the year of transfer. In which year it was transferred? It was transferred in 24-25 divided by cost inflation index in the year of purchase. When it was purchased? 14-15. So cost of acquisition 10 lakhs, year of transfer. It was transferred in 24-25. 24-25 index number 363. Year of purchase. When it was purchased? 14-15. Index number 240. So how much it will be? 10 lakhs into 363 divided by 240. 15 lakh 12,500 you can claim as indexation. Are you able to understand? So whenever capital asset is transferred before 23rd July 24, in place of cost of acquisition, you can claim indexed cost of acquisition as deduction. Is it clear? Not only for cost of acquisition, even for cost of improvement also indexation benefit is available. So for cost of improvement, indexation is equal to cost of improvement into cost inflation index in the year of transfer divided by cost inflation index in the year of improvement. My father has a building. That building was constructed in 1994. Whether cost inflation index number is available for 94-95? No. Cost index number is available for 2001-2. That means cost inflation index numbers are available from 2001-2. If any capital asset is purchased before 1st April 2001, then cost inflation index number is 100. So if any building is purchased in 2001-2 or before 2001-2, cost inflation index number that you have to take is 100. That's why here indexed cost of acquisition is equal to cost of acquisition into cost inflation index in the year of transfer divided by cost inflation index in the year of purchase or 100. When you have to take 100, you have to take 100 if date of acquisition is before 2012. If date of acquisition is either 2012 or before 2012, then index number is not available. That's why you will take index number as 100 rupees only. Next, indexation facility is available to previous owner holding period. What do you mean by this? On 1st April 2008, I purchased building. I gave this building as a gift to Satish on 9th July 2018. Satish sold building on 6th April 2021. Now who sold building? Satish sold building. Who is required to calculate capital gains? Satish is required to calculate capital gains. To calculate capital gains, we have to determine whether it is short-term capital asset or long-term capital asset. So in the hands of Satish, first we need to determine whether building is long-term capital asset or short-term capital asset. Two options are there. Generally, period of holding will be calculated from date of receipt of gift. Income Tax Act says that period of holding should be calculated from date of receipt of gift up to the date prior to the date of transfer. So alternative one is period of holding will be calculated from 9th July 2018 to 5th April 2021. It's not 6th, it's 5th. 5th April 2021. This is alternative one. There is a Supreme Court case law. In that case law, it was said that period of holding can be calculated from previous owner purchase date. So who is previous owner? I am the previous owner. When I purchased 1st April 2008, that means for this period you can calculate period of holding. That is alternative 2. So alternative 2 is I can calculate period of holding from 1st April 2008 to 5th April 2021. Generally, period of holding will be calculated from date of receipt of gift. However, there is a Supreme Court case law. As per that case law, period of holding can also be calculated from date of purchase of previous owner. Indexation benefit is not available in certain cases. What are those cases? For bonds or debentures, indexation benefit is not available. That means for bonds or debentures, even though they are long-term capital asset, you can claim only cost of acquisition as deduction. You cannot claim indexed cost of acquisition as deduction. Next, capital indexed bonds. For capital indexed bonds issued by government, you can claim indexed cost of acquisition. For sovereign gold bonds issued by RBI also, you can claim indexed cost of acquisition. Next, for depreciable assets are always treated as short-term capital assets. If they are treated as short-term capital assets, indexation benefit is not available. And we have discussed market-linked debentures, units of specified mutual fund. All these are always treated as short-term capital assets, right? As these are always short-term capital assets, indexation benefit is not available. What I said, indexation benefit is available only for long-term capital assets. Market-linked debentures, depreciable assets, units of specified mutual fund acquired on or after 1st April 23, all these are always treated as short-term capital assets. As they are always treated as short-term capital assets, indexation benefit is not available. Next, equity share in a company on which STT is paid. These are nothing but for these two capital assets, section 112A or 111A gets attracted. If section 112A or 111A gets attracted, indexation benefit is not available. That's why for these two capital assets, indexation benefit is not available. Because like equity shares acquired, listed equity shares acquired on which STT is paid, that is covered under section 112A. So those capital assets which are covered under section 112A or 111A, indexation benefit is not available. For virtual digital asset also, indexation benefit is not available. Cryptocurrency, Bitcoin, SHIB, okay, whatever the cryptocurrencies are there, on sale of them, indexation benefit is not available. For remaining other long-term capital assets, indexation benefit is available. And indexation benefit is also not available for non-resident. For non-resident also, indexation benefit is not available. Please listen. Major amendment after 23rd July 2024. Even if you transfer long-term capital asset, indexation benefit is not available except in one situation. See, 23rd July 2024 is there. Before, if you are transferring long-term capital asset, indexation benefit is available. On or after, if you are transferring long-term capital asset, indexation benefit is not available except in one situation. That means what? Even after 23rd July 24 also, for long-term capital asset transfer, indexation benefit is available but only in one situation. Generally, after 23rd July 2024, on transfer of long-term capital asset, indexation benefit is not available except in one situation. What is that one situation? You can see, if capital asset being land or building or both purchased before 23rd July 24 is transferred by resident individual or resident HUF on or after 23rd July 2024, indexation benefit is available for tax calculation purpose. Will be discussed in detail. At the end of this chapter, I am going to discuss this amendment because we also need to do one problem, then you will get clarity. Generally, after 23rd July 2024, indexation benefit is not available on transfer of long-term capital asset except in one situation where land or building is transferred by resident individual or HUF. That exceptional situation along with problem I am going to discuss in upcoming video. Okay. Thank you.